guys, welcome back. Welcome to the last section of chapter 1. Last section. Just the sound of it make me happy. Okay, after the first knowledge point. So, these three factors looks very familiar, isn't it? Yes, because we have covered them in defining the goal of investments. These three factors here are also what build up the required return. Now, we have said that we can break them one by one. Now, what we are going to do is to separate them in the form of rate of return. Now, the first element, the real risk-free rate. Let's imagine a world where there's no inflation and you have full certainty about your future investment return. Only then you will look at the rate of return directly, and that return would be the real risk-free rate. So exclude the factor of inflation and exclude the uncertainty factor. What's left out is the real risk-free rate. Now, we have actually come across this term before. It is referred as pure time value of money, because in that world, the only sacrifice we make to invest is to postpone our spending. So, it is referred as pure time value of money. It is mainly determined by two factors. One, subjective, that's the time preference. One is more objective, that's the investment opportunity. Now, the time preference indicates that the desire you want to spend now. If you want to invest, you will have to fight off this desire and make the sacrifice. Only then you will be deserving the time value of money. So what the market do is they combined the investors' time preference together. So we have let's say a time preference pool. The reason why we do that is because we want a composite time preference. So if one investor change his or her time preference, it's okay. It might be offset by the change in time preference held by others. So in that way, we have a relatively stable time preference in the market. Now, the investment opportunity. It's quite interesting because investment opportunity are actually determined by the long-term economic condition. If the economy is soaring, it's growing, it has rapid growth, then the investment opportunity would be, well, it would be plenty. So, in that case, investors would demand, the provider of funds would demand a higher interest payments because they know that the people who borrow money, let's say individual investors, organizations, government, they want to jump off to the train of rapid growth. So they are willing to make larger compensation to get the opportunity. So that's why a more plentiful, let's say a higher chance of investment opportunity would give rise to a larger cause to demand higher interest. So pay attention that this one is actually determined by long-term economic growth or economic condition. So these give rise to a positive correlation between the real risk-free rate and long-term economy. The reason why I am mentioning that is because when we talk about long-term economy, it is relatively stable, even in the long term. It won't have a sudden change. It won't be like the nominal rate, which is what we are going to talk about in later slides. But now, let's consider a case. Do we live in a world where there's no inflation? No, we live in a world with inflation. So, if we only have RFR, that's our real risk-free rate, then what we actually get are actually lower than this rate because of the presence of inflation, because of the loss in purchasing power of one certain currency. So, if we want to really compensate ourselves, to really make sure that we have that RFR in pocket, we need to consider two other elements. The first one is conditions in the capital market. It's very similar to the opportunity set, which we will leave out because the later one is more relevant, which is also the driving force behind the change of nominal risk-free rate. That's the presence of inflation. So the nominal risk-free rate can be observed directly by our eyes, while RFR is more likely to be a calculation of product. So the inflation. When inflation changes, it will lead to a change in NRFR, which can be directly observed by our eyes, which is why the NRFR is much less stable compared to RRFR. And when we do the transition between RFR and NRFR, we use these two equations, and these are the famous Fisher effect. If you want to know more, just Google it. Okay, so NRFR, it equals to 1 plus RFR, that's our real risk-free interest rate, and then times 1 plus the inflation, and then minus 1. So that gives us the NRFR. Just remember, NRFR is more directly, it's what we normally use because RFR cannot be seen by eyes directly. What we can see by eyes directly is the NRFR in combination with the effect of inflation. And if we want to know RFR, here's the equation you can follow. All right, now let's go back to these slides. What we are looking at here, time value of money, that gives us RRFR, that's real risk-free rate. And then in the combination of inflation, that gives us the presence of nominal risk-free rate. But we know that these two are more market-driven. It's more like the outside or exogenous factors that determines your investment returns. But are they full? Is that it? No. We have one final determinant, that's the risk, very specific to your investments. So it's more like the inner factor, and these are the outside factor. So what we are going to learn is what is the source of this inner risk. Now, let's quickly do it. Time travel back to here. Now, the first one, the most foundational one, the most essential one is the business risk. So when we invest, normally the underlying asset is tied to a listed firm, a company. And a company has its business operations. It might be a job in sales or profit. Well, if there's something unpleasant happen. So if that happens, remember, what is share price? It's essentially an investor's outlook for a firm's future, for future's prospect. So if a current operations, especially the profitability, goes down, then the investors might also turn down their expectations for firm's future, which will lead to a lower share price and also a lower rate of return if we invest in these firms' stock. So that's why business risk, or let's say the uncertainty about profitability, lead to the inner risk. As long as your investment is listed in the market, as long as it is doing its business, then this risk will exist. Now, financial risk. This only happens when firms borrow funds from credit union or debt holders. Now, we know that shareholders are residual value holders. That means that if the firm goes bankruptcy, the firm has to pay off its obligations held by the debt holders. And only after all those payments, what is left goes to shareholders. So shareholders get the residual value. Now, this creates the fear or the nightmare of shareholders because the larger claim held by debt holders drives down what shareholders can claim from the company. So when the firm is highly leveraged, that means they borrow a great amount of funds from the market, then the shareholders would consider this credit risk. So they would push up their required return for investing in firm's stock. So financial risk drives up our risk premium. Now remember, though it's not euro, a firm can be all equity funded. For a firm like that, there will be no financial risk because there's no presence of debt holders. Now, liquidity risk. We have actually talked about it because it refers to how long you can sell out your investment and how likely you can receive the price you want. So, if it takes larger time to convert your investment to capital gains or to cash, then the lower the liquidity, which is said to be illiquid. Now, the other elements. How certain can you ensure that you can get the price you want? The less certain attitude indicates higher illiquidity or lower liquidity. So that's a mouthful, right? Yeah, these two. If a investment comes with a higher level of illiquidity, that indicates larger liquidity risk, which is also why you can demand a higher return. Now, the exchange rate of risk. Remember, this one is more like an optional one because it can only happen when you invest in a foreign market. It happens when you convert your investment returns back to your home currency. Sometimes the exchange rate is in your favor, and that helps to build up or expand your rate of return. Sometimes it acts in the opposite way. It will push down your rate of return. But you can always avoid it by investing in your domestic market. But what is the fun, right? Now, the last one we talk about in our section here, even though this is not the end of inner risk determinants, well, it is there. It is a, less common one compared to the previous four. It is the country risk. It happens when the country, let's say, might at war. It also refers to a sudden change in the economic condition. So these two elements that are also very exogenous builds up the requirement of return. Because this uncertainty is just really unlikely to fight off. So my advice would be avoid countries that have unstable political conditions or countries that are at war. So these are the 5 most common category of risk that are very specific or relevant to the investment itself. Have you enjoyed them? And I'll see you in our next chapter.